studying your last two. I swim med when turned in. The styren down to mute. And can learn the pole that sunk he died.
One of the most important concepts in dividend administration is that dividends are declared per share, not per person. This may sound like a small distinction, but it has significant legal and accounting implications. When a corporation declares a dividend, it does not decide that a particular shareholder will receive a specific dollar amount. Instead, the corporation declares a dividend amount for each eligible share. Once that per share amount is established, every eligible share receives the same dividend. In this example, the corporation declares a dividend of $10 per share. The amount each shareholder receives depends entirely on the number of shares they own. John owns 100 shares. Since each share receives $10, John receives $1,000. Sarah owns 50 shares. At $10 per share, Sarah receives $500. David owns 25 shares. At $10 per share, David receives $250. Notice that the corporation never declared a $1,000 dividend for John or a $500 dividend for Sarah. The corporation declared a $10 dividend per share, and the shareholder amounts were simply the result of applying that rate to the number of shares owned. This principle becomes especially important when corporations have multiple shareholders or multiple classes of shares. The accountant must always think in terms of shares first and shareholders second. The key takeaway is simple. A dividend is declared per share and then applied to every eligible share. The amount a shareholder receives depends on the number of shares owned, not on the shareholder's name or personal circumstances. Understanding this concept is the foundation for calculating dividends correctly and documenting them properly. Once you understand that dividends are declared on a per-share basis, the next question becomes, how do we determine the correct dividend amount per share? In practice, accountants often start with the total amount of cash that a shareholder or group of shareholders wants to receive. For example, suppose the goal is to distribute $50,000 from the corporation. The next step is to determine how many eligible shares are entitled to receive the dividend. This information is obtained from the share register and other corporate records. In our example, there are 500 eligible shares outstanding. Now comes the key calculation. To determine the dividend per share, divide the total dividend desired by the number of eligible shares. $50,000 divided by 500 shares results in a dividend of $100 per share. Once the per share amount has been calculated, applying it to individual shareholders becomes straightforward. Each shareholder receives the same amount per share, multiplied by the number of shares they own. In this example, shareholder A owns 200 shares. At $100 per share, they receive $20,000. Shareholder B owns 300 shares. At $100 per share, they receive $30,000. Notice that the accountant is not deciding how much each person receives individually. Instead, the accountant calculates a single per share amount, and the shareholder results flow automatically from their ownership position. This approach ensures consistency, accuracy, and compliance with corporate law requirements. It also creates a clear audit trail that supports the dividend declaration and related tax reporting. The key takeaway is that dividend calculations often work backwards. Start with the total dividend desired. Determine the eligible shares. Calculate the per-share dividend, and then apply that amount to each shareholder based on the number of shares owned. Once the per-share dividend is established, every eligible share receives the same amount. Dividend calculations can be relatively simple when a corporation has only one class of shares. In that situation, Every share has the same rights, and a single per-share dividend calculation is usually all that is required. For example, if a corporation has 100 common shares outstanding and declares a dividend of $20 per share, the calculation is straightforward. 100 shares multiplied by $20 per share results in a total dividend of $2,000. However, things become more complicated when a corporation has multiple share classes. Many private corporations have Class A shares, Class B shares, preferred shares, and other customized share classes, each with potentially different dividend rights. In these situations, you cannot assume that the same dividend applies to every share. Different share classes may have different entitlements, restrictions, priorities, or fixed dividend provisions. As a result, separate calculations may be required for each class. For example, one class of shares might receive $20 per share, another class might receive $30 per share, and preferred shares might be entitled to a fixed dividend amount under their terms. Each class must be reviewed and calculated separately according to its rights. This is why dividend planning becomes more complex as the share structure becomes more complex. Before any calculations are performed, the accountant should review the share classes, verify the dividend rights attached to each class, determine the number of shares outstanding, confirm the shareholders who own those shares, and then calculate the appropriate per-share dividend amounts. Just as important, all calculations should be documented and retained in the working papers. Proper documentation helps support the dividend declaration and provides evidence of the methodology used if questions arise later. The key takeaway is that the more share classes a corporation has, the more important accurate dividend calculations become. A careful review of the share structure is essential to ensure that dividends are calculated correctly, paid legally, and reported properly.